Most people have no idea if they're winning or losing financially. They work, they earn, they spend, they save something maybe. But they have no framework for understanding whether they're on track or falling behind. They reach 45 or 55 and suddenly realize they should have been measuring something all along. I was one of these people for too long. I earned money. I spent money. I vaguely hoped things were going well. I never sat down and calculated where I actually stood relative to where I needed to be. When I finally did the math, the result was uncomfortable, not devastating, but years behind where I could have been with better awareness. That calculation changed everything. Seeing the gap between where I was and where I should have been created motivation that vague hope never could. Tracking progress over time showed me what worked and what didn't. Benchmarks gave direction when I felt lost. Today I'm giving you what I wish someone had given me when I was younger. Specific net worth targets for every decade of life, updated for current economic reality. Not outdated numbers from different eras, not theoretical ideals disconnected from how people actually live. Practical benchmarks that tell you whether you're on track for the retirement you want or heading toward the retirement you'll have to accept. These numbers might encourage you. They might alarm you. Either response is useful. What's not useful is not knowing at all. Let me start with why measuring net worth by age matters in the first place. Financial progress isn't obvious. You can feel like you're doing well because you earn good money while actually falling behind. You can feel like you're struggling because money is tight while actually building substantial wealth. Feelings are unreliable, measurement reveals truth. Age-based benchmarks provide context that raw numbers can't. Having $200,000 means something very different at 30 than at 60. Without age context, you don't know whether to celebrate or worry. These benchmarks work as direction, not judgment. The goal isn't comparing yourself to others and feeling superior or inferior. The goal is understanding whether your trajectory leads where you want to go. A person behind benchmark who's accelerating is in better position than a person at benchmark who's stagnating. Wealth building is a long game. Decades long. The decisions you make at 25 compound into the reality you face at 65. Benchmarks at each stage help you course correct before small deviations become large problems. And retirement readiness is the ultimate objective whether you think about it that way or not. Unless you plan to work until you die, you need accumulated wealth that sustains life without employment income. The benchmark targets I'll share are reverse engineered from that requirement. They represent the path to retiring with dignity rather than desperation. Tracking consistently matters more than tracking perfectly. Even rough annual calculations of where you stand create awareness that improves decisions. The spreadsheet doesn't need to be elaborate. The practice of looking creates the benefit. But before I give you numbers, I need to explain something about the data that most people get wrong. When you see statistics about net worth by age, you'll typically see two numbers, average and median. These numbers are dramatically different, and confusing them leads to either false comfort or unnecessary panic. The average is distorted by outliers. If 9 people have $100,000 and one person has 10 million, the average is over 1 million. But nobody in that group actually has 1 million. The ultra-wealthy pull the average up to a level that represents almost nobody's reality. The median is the middle point, half above, half below. This gives a more realistic picture of what typical people actually have. The gap between average and median grows larger with age because wealth concentration accelerates over time. The people who build substantial wealth separate further and further from the people who don't. I'll give you median figures because they're more useful for understanding where you stand relative to typical people. But I'll also give you targets that exceed the median because being typical may not be enough. Being average at wealth building often means inadequate retirement. The median retirement account balance for near retirees suggests most people will struggle. Average isn't the goal. Above average is the goal if you want retirement security rather than retirement anxiety. The psychological danger of comparing to inflated statistics is real. People see average net worth figures, realize they're far below, and feel hopeless. That hopelessness prevents action. Understanding that the average is distorted by billionaires removes that despair and replaces it with realistic assessment. Now let me make sure we're defining terms correctly. Net worth is simple. Assets minus liabilities. What you own minus what you owe. Assets include everything with monetary value. Bank accounts, investment accounts, retirement accounts, real estate equity, vehicles, valuables, business ownership. Everything you could theoretically convert to cash liabilities include everything you owe: mortgages, car loans, student loans, credit card balances, personal loans, medical debt, everything you're obligated to pay. Subtract total liabilities from total assets. That's your net worth. It can be positive, zero, or negative. Many young people have negative net worth, and this doesn't mean failure. If you have $30,000 in student loans and $5,000 in savings, your net worth is negative $25,000. This is normal early in adult life when education debt exists but asset accumulation hasn't begun. The trajectory matters more than the starting point. Negative net worth that's improving rapidly is healthier than positive net worth that's stagnating. I calculate my net worth annually, same time each year. I track everything in a simple spreadsheet. Assets on one side, liabilities on the other, net worth at the bottom. Year-over-year comparison shows whether I'm progressing. This annual practice takes maybe an hour and provides clarity that lasts the entire year. The return on that hour of effort is enormous. Now let me walk you through what your net worth should be at each stage of life, why those numbers make sense, and what you should focus on to hit them. Your 20s are foundation years. The numbers look small, but the habits you build determine everything that follows. The median net worth for people in their 20s is quite low, often under $50,000, sometimes negative when student loans are significant. This doesn't mean you should aim for the median. It means the median is a floor, not a ceiling. A useful target by age 30 is having net worth equal to 1 times your annual salary. If you earn $60,000, aim for $60,000 net worth by 30. If you earn $40,000, aim for $40,000. This might seem aggressive given where many 20-somethings start, but it's achievable for most people who prioritize it. The 20s are about avoiding catastrophic mistakes and building accelerating momentum. Avoid high-interest consumer debt like it's poison. Credit card balances at 20% interest will destroy wealth building faster than almost any positive action can build it. Pay these off immediately and don't accumulate more. Education debt at lower interest rates is more tolerable if it was taken strategically. A loan that enabled a degree that meaningfully increased earning power can make mathematical sense. But have a repayment plan. Don't let these loans linger for decades. Prioritize savings rate above almost everything else. The percentage of income you save matters more than the absolute dollar amount when you're young. Target 15 to 20% minimum, higher if possible. The compound growth advantage of early investing is your superpower. Money invested at 23 has over 40 years to grow before traditional retirement. Money invested at 33 has only 30 years. That decade difference produces dramatically different outcomes, even with identical contributions. Experiment with skills and income streams. Your 20s are when mistakes cost least. Try things, fail at things, learn what you're good at, build earning power that serves you for decades, invest in career capital, skills, credentials, relationships, and reputation that increase your professional value over time. Early career decisions about what capabilities to build echo through your entire working life. Monetize knowledge or interests if you can. Side income streams established in your 20s can grow into substantial contributors to wealth by your 40s. Choose long-term wealth over short-term lifestyle. The lifestyle your friends are displaying is often financed with debt or enabled by parental support. Don't match spending that you can't actually afford just to appear successful. Play the long game. Your 20s aren't about perfection, they're about trajectory. Small numbers growing rapidly are more valuable than larger numbers stagnating. This connects to something that determines most financial outcomes regardless of income. The power of compounding creates outcomes that seem impossible until you see the math. Small percentage differences in savings rate produce enormous differences in retirement outcomes. Someone saving 5% of their income will retire with a fraction of what someone saving 15% will have, even if they earn identical salaries for identical careers. If two people both earn $60,000 annually for 40 years, but one saves 5% and one saves 15%, the difference at retirement isn't 3 times. It's dramatically larger because the 15% saver's money had more to compound. I've run these calculations countless times. They consistently produce the same conclusion. Savings rate during early years matters more than almost any other variable. Time in the market beats timing the market. Trying to pick perfect entry points usually results in sitting on cash while markets rise. Consistent investing, regardless of conditions, produces better outcomes for most people than waiting for ideal moments that never feel ideal when they arrive. Early consistency beats late intensity. Investing modest amounts in your 20s produces better outcomes than investing larger amounts starting in your 40s, because the early money has so much more time to work. This is why the 20s benchmark matters, even though the numbers seem small. Building the habit and letting time work is more important than the specific dollar amounts at this stage. Moving into your 30s, the game changes substantially. Your 30s are wealth-building mode. The foundation from your 20s should now support aggressive scaling. The median net worth for people in their 30s is still quite modest, perhaps 100 to 200,000 depending on the study and the exact age. The average is much higher, again distorted by those who inherited wealth or had exceptional outcomes. A useful target by age 40 is having net worth equal to 3 times your annual salary. If you earn 80,000, aim for 240,000 net worth by 40. This represents a significant jump from the 1 times target at 30. The 30s are when serious wealth momentum should build. Your prime earning years are beginning. Career progress typically accelerates during this decade. Income should be growing meaningfully if you invested in career capital during your 20s. Eliminate all non-mortgage debt during this decade. Car loans, student loans, credit cards, personal loans. Everything except potentially your home mortgage should be gone. These debts drain cash flow that could be building wealth. Avoid lifestyle inflation despite higher income. This is the most common failure point for high earners. Income rises and lifestyle rises proportionally, leaving the same margin as before despite larger numbers. The correct response to raises is increasing investment, not increasing spending. Your lifestyle should expand much slower than your income. The gap between them is where wealth accumulates. Build a substantial emergency fund during this decade. 3 months minimum, 6 months better, 12 months ideal if your income has any volatility. This fund prevents setbacks from derailing progress. Financial responsibilities often increase during the 30s. Children appear, houses are purchased, parents may need help. Each new responsibility requires financial capacity. The median benchmark should be treated as a floor to exceed, not a target to reach. Overshooting the median is the strategy, because the median represents people who will struggle in retirement. Retirement projections start mattering during this decade. You can now see the general trajectory of where you'll land. Make adjustments while there's time. The challenge that undermines this decade more than any other deserves specific attention. Lifestyle inflation is the silent killer of wealth during the 30s. Income growth feels like victory, finally earning what you feel you're worth, finally able to afford things you couldn't before, finally looking successful to others. The trap is raising fixed costs to match income. Larger apartment, larger mortgage, larger car payment, more expensive habits, higher baseline spending in every category. Once these costs are established, they're difficult to reverse. You're locked into earning at that level indefinitely just to maintain the lifestyle you've created. The alternative is keeping fixed costs controlled while income rises. Let income grow faster than lifestyle. Bank the difference. Direct raises toward investments, not spending. When you get 10% more income, invest 10% more. Don't spend 10% more. The margin between income and spending is what creates freedom. Large margin means options. Small margin means vulnerability. Some people earn 300,000 and have no margin. Others earn 80,000 and have substantial margin. The second person has more financial security despite lower income because margin creates resilience. Your 40s bring a shift from building to optimizing. This decade is the strategic planning phase. Accumulation continues, but the focus becomes clarity about where you're heading. A useful target by age 50 is having net worth equal to 6 times your annual salary. If you earn 100,000, aim for 600,000 net worth by 50. Major financial priorities must be explicitly defined during this decade. What matters most? What are you building toward? What trade-offs are you willing to make? Mortgage payoff planning becomes relevant. What's the timeline to owning your home outright? How does that fit with other priorities? College funding for children requires decisions. How much will you contribute? What's the balance between children's education and your retirement? Knowing your retirement number is essential by the end of this decade. How much do you need to retire with the lifestyle you want? Most people have never calculated this. Without the target, you can't know if you're on track. Reverse engineer retirement needs. Start with the lifestyle you want. Calculate what that costs annually. Apply withdrawal rate math. Determine the portfolio size required. Now you have a real number. Estate planning belongs in this decade. Wills, healthcare directives, power of attorney, beneficiary designations. These documents protect your family if something happens to you. They're uncomfortable to create and essential to have. The 40s demand clarity that previous decades didn't require. Building is no longer enough. You need to know what you're building toward. Entering your 50s, the focus shifts to protection and strengthening. This decade is pre-retirement positioning. The finish line is now visible even if it's still years away. A useful target by age 60 is having net worth equal to 8 times your annual salary at minimum, preferably 10 to 12 times if possible. This jump from 6 times to 8 to 12 times might seem steep, but retirement draws closer, and the portfolio must reach a size that sustains decades of living expenses. Portfolio diversification matters more now. The aggressive growth approach of younger years carries too much risk when retirement is close. A major market crash in your late 50s with no time to recover is catastrophic. Gradual shift toward capital preservation makes sense, not entirely eliminating stocks, but balancing growth investments with stable investments that won't collapse at the worst possible time. Reduce volatility risk without eliminating growth entirely. You still need returns during retirement, but you can't afford massive drawdowns right before you need to start withdrawing. Define retirement lifestyle expenses specifically. What will your life actually cost in retirement? Most people guess. Guesses are usually wrong. Calculate it using real current expenses adjusted for what will change. Understanding withdrawal rate math becomes critical. The 4% rule suggests you can withdraw 4% of your portfolio annually. With reasonable confidence, it will last 30 years. More conservative estimates suggest closer to 3.5%. More aggressive estimates suggest 4.5 or higher. This means a $1 million portfolio might provide $40,000 annually in withdrawals. $2 million might provide $80,000. Match your required expenses to the portfolio needed to fund them. Maximize catch-up contributions available after 50. Retirement account limits increase for people over 50 specifically because this decade is crucial for final wealth building. Use every available tax-advantaged dollar. Strategic final wealth push during this decade can significantly impact retirement timing and comfort. These are often your highest earning years. Direct that earning power toward maximum accumulation. Account optimization deserves specific attention during this phase. Catch-up contribution advantages after 50 exist because policymakers recognize this decade matters. After 50, you can contribute additional amounts to retirement accounts beyond standard limits. The exact numbers change annually, but the principle remains. Extra tax-advantaged space is available specifically for pre-retirement wealth building. Maximize 401k and IOR contributions to the legal limit if at all possible. Every dollar in these accounts grows tax-deferred or tax-free depending on the account type. The tax advantages compound alongside the investment returns. Tax-advantaged growth is most valuable when you still have time to compound. The final decade of contributions benefits from this, even if less than earlier contributions did. These final years of contributions can meaningfully increase retirement security. Don't leave tax-advantaged space unused if you have any ability to fill it. Your 60s are about execution and stability. This decade is the transition from accumulation to preservation. The game changes entirely. A useful target by age 65 is having net worth equal to 10 times your annual salary at minimum. Ideal is closer to 20 times for genuine security. This range is wide because individual circumstances vary dramatically. Someone with pension income has different needs than someone fully dependent on portfolio withdrawals. Someone in low-cost housing has different needs than someone with expensive fixed costs. Finalize retirement timeline during this decade. When exactly will you stop working? This drives every other decision. Social security timing decisions matter significantly. Claiming early at 62 reduces benefits permanently. Waiting until 70 increases benefits substantially. The right choice depends on health, longevity expectations, spouse considerations, and other income sources. Withdrawal strategy must be clear before retirement begins. Which accounts will you draw from first? How will you minimize taxes across the withdrawal period? What happens if markets decline early in retirement? Ensure your home is paid off by retirement if at all possible. Carrying a mortgage into retirement means larger monthly obligations from fixed income. A paid-off home dramatically reduces the portfolio size needed. Expenses in retirement are often lower than during working years. No commuting costs, no work wardrobe, no payroll taxes on income, often less eating out. The transition can reduce spending naturally. Downsizing lifestyle, if needed, should happen before or at retirement, not after money runs out. Proactive adjustment is dignified. Forced adjustment later is painful. Preserve wealth rather than chase returns at this stage. The goal isn't growing rich in retirement, it's not running out. Conservative allocation makes sense when you can't afford to lose what you have. The relationship between nest egg and income replacement deserves clear explanation. The 4% rule provides a simple framework. If you withdraw 4% of your portfolio annually, historical data suggests it will last 30 years in most scenarios. Working backward, if you need $40,000 annually from your portfolio, you need $1 million. If you need $80,000, you need $2 million. If you need $120,000, you need $3 million. The math is 25 times your needed annual withdrawal. This creates the nest egg target that supports that income indefinitely. Why 20 to 25 times expenses rather than income? Because income and expenses are different. Most people don't need to replace 100% of their working income. They need to cover their actual expenses, which are often lower. Calculate your real retirement expenses. Social Security may cover some, pension may cover some. The remainder must come from portfolio withdrawals. That remainder times 25 equals your required portfolio. The safety buffer concept matters. Hitting exactly the minimum number creates no margin for error. Medical emergencies, market downturns, helping family, unexpected expenses. Building buffer above minimum provides breathing room. Balancing preservation and growth doesn't end at retirement. When to reduce risk is partly art, partly math. The general principle is reducing stock allocation as retirement approaches. But retirees who go entirely conservative face a different risk. Their money not lasting because returns are too low. Balancing stocks, bonds, and real estate remains important even in retirement. Stocks provide growth that keeps pace with inflation over time. Bonds provide stability that prevents catastrophic drawdowns. Real estate can provide income and diversification. Sequence of returns risk is a specific danger in early retirement. If markets decline severely right after you retire and you're withdrawing living expenses, you're selling shares at low prices. This sequence can devastate portfolios, even if average returns over the full retirement are normal. Holding conservative assets to cover early retirement years helps manage this risk. Long-term sustainability requires thinking in decades even during retirement. A 65-year-old might live 30 more years. The portfolio must last that entire period, not just the first few years. What I've shared is technical, but the psychological journey through these decades matters equally. Your 20s are experimentation years financially. You should be trying things, making mistakes, learning your own patterns with money, building habits that will serve you later. The specific numbers matter less than establishing trajectory. Your 30s require discipline. The habits from your 20s must become systems. Consistent investing regardless of market conditions. Consistent living below your means. Discipline replaces experimentation as the primary requirement. Your 40s demand strategy. Discipline continues but must be directed by clear vision. Where are you going? What trade-offs make sense? What doesn't matter anymore? Strategy emerges from knowing what you're building toward. Your 50s are about protection. The wealth you've built becomes more important to preserve than to grow. Protecting what exists while continuing to build creates the transition toward retirement. Your 60s are security-focused. The aggressive approaches of earlier decades give way to ensuring what you have sustains you indefinitely. Security becomes the primary objective. Each decade has different psychology. The person who's still experimenting at 50 or still aggressive at 65 hasn't adapted to their phase. The person who's overly conservative at 30 hasn't taken advantage of their phase. Matching psychology to decade optimizes outcomes. Let me step back and share the broader philosophy underlying all of this. The median numbers I've referenced are floors, not ceilings. Being typical at wealth building produces typical retirement outcomes. Typical outcomes often mean financial stress in late life. Overshooting targets at every stage creates the freedom that retirement should provide. Having 20 times income instead of 10 times means options, ability to help family, ability to handle emergencies, ability to enjoy life without constant worry about money running out. Wealth building is more predictable than most people realize if you understand and apply the math consistently. It's not about luck or timing or special knowledge. It's about savings rate, time, and reasonable investment returns compounding over decades. Retirement comfort depends on the accumulated habits of an entire adult life. The person who starts at 25 with consistent good habits ends up somewhere fundamentally different than the person who starts at 45. The math is unforgiving, but it's knowable in advance. Money management must evolve with age. The strategies that work at 30 don't work at 60. The psychology that's appropriate at 25 isn't appropriate at 55. Adaptation to your phase is essential. I want to leave you with specific action regardless of what decade you're in. If you're in your 20s, calculate your current net worth even if it's negative. Establish a system to track it annually. Set a target to reach 1 times your salary by 30. Build a savings rate habit that makes this achievable. Avoid consumer debt. Start investing even small amounts now. If you're in your 30s, calculate your current net worth and compare to the 3 times salary target for 40. Identify the gap. Eliminate non-mortgage debt aggressively. Resist lifestyle inflation from income growth. Build emergency fund if not already established. Increase savings rate. If you're in your 40s, calculate your current net worth and compare to the 6 times salary target for 50. Define your retirement number specifically. Create timeline for mortgage payoff. Complete estate planning documents. Get clear on what you're building toward. If you're in your 50s, calculate your current net worth and compare to the 8 to 12 times target for 60. Maximize catch-up contributions. Begin shifting toward more conservative allocation. Define retirement expenses specifically. Understand withdrawal rate math for your situation. If you're in your 60s, finalize retirement timeline. Make social security timing decision. Establish withdrawal strategy. Ensure home is paid off. Preserve capital while maintaining reasonable growth. Prepare for the transition. Wherever you are, the first step is knowing where you stand. Net worth calculation, comparison to benchmarks, gap identification, action to close the gap. The people who will retire comfortably started this process decades before retirement. The people who will struggle avoided looking at the numbers until it was too late to meaningfully change them. Write in the comments what decade you're in and whether you're above or below the benchmark I've shared. Sometimes articulating where you stand creates commitment to improve. Share this with someone who's never calculated their net worth or thought about these benchmarks. They might be on track without knowing it. They might be behind and need the wake-up call. Either way, the information serves them. The numbers might seem daunting or they might seem achievable, depending on your current position. Either reaction is useful. Daunting means you have work to do, and now you know. Achievable means you're on track and can confirm it. Both are better than not knowing at all. Your future self will either thank you for paying attention to these benchmarks or wonder why you didn't. Make sure it's the first one.